So I have some information to share with you that is rather urgent, and it has to do with Jerome Powell and the data that we get tomorrow. So we are going to go over that here in this video. I'm going to give you a full rundown. I actually have a clip to play from Fed Waller, and he got no attention at all. The markets didn't even pay attention to what he said, but it could set you up for a surprise from Powell coming tomorrow. Problem is, markets are not open. Good news is, if we do get a surprise and markets start to go through a correction in which, if you ask money managers, hedge funds, institutions, the markets are overdue for a correction anyways, and a vast majority of them, about 62% of them, are expecting a correction over the next couple of weeks. Doesn't mean it's going to happen, but when you have that many people expecting a correction and everyone positioned bullishly, it doesn't set you up in a favorable way, and we may have just got a warning from Fed Waller about 15 hours ago now that Jerome Powell might surprise us tomorrow. With that said, we're also going to talk about Tesla's delivery numbers that will be coming out on April 2nd and why I think you may actually see a positive reaction in Tesla stock despite missing analyst consensus estimates. And I think you guys will get a lot of value out of that. Let's start with a bit of a warning from Fed Waller, and I'm trying to do this in chronological order because the data comes out tomorrow and you hear from Powell tomorrow. Again, unfortunately, markets are closed, but that's the first event coming, so I want to start with that. But the Tesla information we're going to go over here in this video is also critical that you need to know.
In my view, it is appropriate to reduce the overall number of rate cuts or push them further into the future in response to the recent data. This just reflects the reality of managing an outlook in real time as data comes in. Now, subsequent data may well alter this outlook again, but we shall see. Based on what we know now, there is no urgency in taking that step. So where do I see things standing? I see economic output and the labor market showing continued strength, while progress in reducing inflation has slowed. Because of these signs, I see no rush in taking the step of beginning to ease monetary policy. The target range for the federal funds rate has been 5.25% to 5.5% since last July. And I believe that this restrictive level is helping to reduce imbalances in the economy and continuing to put downward pressure on inflation. All indications are that the economy continues to grow at a healthy pace. While retail sales and some other indicators suggest a softening in demand this quarter from the second half of last year when growth accelerated, the evidence for a significant slowdown is sparse. Meanwhile, as the labor market continues to add jobs at a rapid pace, some signs point to improvement in the imbalance between supply and demand, but others indicate continued tightness. My judgment on the balance of risk for monetary policy, which I explained in a speech on February 22nd, hasn't changed. The risk of waiting a little longer to cut rates is significantly lower than acting too soon. Cutting the policy rate too soon and risking a sustained rebound in inflation is something I definitely want to avoid. As a result, in the absence of an unexpected and material deterioration in the real economy, I'm going to need to see at least a couple of months of better inflation data before I have enough confidence that beginning to cut rates will keep the economy on a path to 2% inflation. Fortunately, we can wait and see how the data come in before deciding the appropriate time to start lowering the policy rate. The remarkable U.S. economy keeps on chugging along, adding jobs at a rate that over time will keep unemployment near its current historically low rate. But the overall strength of the U.S. economy makes it a fairly easy decision to wait a little longer to get a better understanding of the trajectory of inflation and, when appropriate, to begin easing policy.
It seems like Wall Street did not care about what Fed Waller said. If Jerome Powell had said that exact same speech, markets would have been down like 3% today. fairly confident in saying at least 2%, okay? Maybe not 3%, but probably like 2%. Algorithms didn't pick up on it. Nobody cared because it wasn't Fed Jerome Powell. Fed Jerome Powell will be speaking tomorrow, and what kind of has me a little concerned that Powell's going to take a more hawkish approach is because I don't think he meant to be as dovish as he was, or at least have the markets interpret what he said as very dovish. When the last summary of economic projections came out on March 20th, I pointed this out for everyone. Wall Street did not pick up on this, nor did they care at all. I didn't see really anyone talking about it. But even the most dovish Fed official expects higher rates by a huge margin now, based on this recent upwards trend we've seen in inflation. Take a look right here at 2024, 2025, and 2026, the range of the federal funds rate. This is showing you the most hawkish Fed official, the official that believes that rates are going to be, high, right, or higher, and the most dovish official that expects the lowest federal funds rate. It's showing you the range. 2026, there was no change. On the low side, it was 2.4%. On the high side, it's 4.9%. So at least one Fed official, at least one, by 2026 is only expecting 2 rate cuts. That would be like nothing. I mean, that would be a pretty bad situation. 2025, the most hawkish Fed official is expecting 5.4% for your federal funds rate. So no change at all for the Fed funds rate for the next 2 years. The lowest dot back in December, the most dovish Fed official, was 2.4%. In March, this latest dot plot, they changed that to 2.6%. So the most dovish Fed official changed their estimate a little bit higher for 2025. But really the action here is for 2024, because back in December, the most dovish Fed official believed the federal funds rate would be 3.9% by the end of 2024. That's like 6 or 7 rate cuts. That's a lot of rate cuts. Okay, without doing the math, just ballparking here, that's like 6 rate cuts, right? If rates are 5.5% and a rate cut is 0.25%, what? That's 2, that's 4. Yeah, that's like 6 rate cuts. Pricing in borderline 7 if you're at 3.9. Well, now the latest dot plot, the most dovish Fed official expects rates to be 4.4% in 2024 by the end of this year. That is a 50 basis point increase. That's a big jump. But yet, all the markets cared about was the fact that the Fed aggregate, on an aggregate basis, expects 3 rate cuts, just taking the average dot from the Fed. You were borderline pricing in only 2 rate cuts. And I think the markets would be in a little bit different of a spot if we only projected 2 rate cuts. Now, maybe Waller is bracing the markets for Jerome Powell tomorrow. That's always a possibility. Over time, I've noticed that if you're going to get a change from Fed Jerome Powell, he's really the one the markets pay a lot of attention to. Back in 2022, the beginning of 2023, the markets paid attention to all the Fed speakers quite a bit, especially like Bullard that would come out and say the Fed funds rate was going to like 6 or 7%. Those were the days back in 2022. I remember the markets sell off 2 to 3% based on what Bullard was saying, and Bullard was pretty hawkish then. Well, the markets really only care about Powell these days. Waller was reading off of a prepared speech in front of him during that clip. Go back and look at that if you did not catch that. But he was reading off of a script pretty much, maybe preparing the markets for a hawkish Powell tomorrow. I don't know if that's going to happen. I said when this dot plot came out, I have to be bullish on markets because the Fed just went super bullish, and I'm expecting some weakness in the economy. That means the Fed's going to cut rates sooner rather than later, or more aggressive than, what I maybe previously thought. So I'm longer run still very bullish on this market. But I do think in the short term, the very short term, like the next 4 to 6 weeks, you could be in for a little bit of a problem in regards to the market's expectations and the Fed's expectations. The Fed got more bearish. The market's seen it as the Fed is more dovish, more bullish. There's a disconnect there. And it doesn't help, according to this survey from CNBC they just did, polling almost 300 hedge fund and institutional money managers. 61% of them believe that the market has run too far, that we're too high. and it has done that too fast. Only 39% believe the markets have more room to run here. That's a pretty bad number. Okay, now everyone's bullishly positioned, so I would expect maybe if we do get a correction, a 5 to 10% pullback, there could be some selling of markets in overstretched positions. But think about the word correction itself. It's correcting something. Now, what needs correcting? Nvidia, Meta, maybe other big tech names, Amazon, Google, probably to a less extent, Apple to a less extent. But by definition, a correction is correcting something that went too far. I think of a correction to the upside or to the downside, right? If stocks correct too much to the downside, you get a correction back to the upside. Right now, you're due for that downside correction. But I'm not convinced that's going to be a huge negative for Tesla, for interest rate sensitive names that really have not done well in 2024. Something very notable to also point out is the Russell 2000 was up 0.5% today. The NASDAQ was down 0.12%. So what that basically is showing me, if you do start to get a correction, it's probably going to be in those big tech names. And today was the last day of Q1. The S&P and the NASDAQ are up 10% plus for Q1, and small caps really did not participate. You've seen investors sell those NASDAQ names and put money into the Russell 2000. Typically, if that's happening the last couple of days of portfolio rebalancing of the end of a quarter, it usually sets you up for a pretty positive next quarter and maybe the quarter after that as well. So I do think maybe you are in a better position for small cap stocks. And again, if you do see a correction, it's probably in your market leaders of the S&P and the NASDAQ that have for sure run too far too fast. But just think about this logically. Does Tesla need a correction? It's fallen 28% to start 2024, I believe closer to about 30% after the day today. No. I mean, the equal weighted S&P is basically flat on the year. The equal weighted Russell is negative like 3% on the year, 2% on the year, something like that. Do those areas need a correction? I don't think so. And I think they're actually priced already for a more hawkish Fed. So here's the caveat when it comes to a correction, whether or not Tesla would do well or sell off. It depends what the reason is. So I talk about markets pricing things in all the time, but it's very important because I think interest rate sensitive names, Tesla definitely, has priced in less rate cuts. It's priced in the Fed holding rates where they are for longer and less rate cuts over the foreseeable future. Just the overall outlook for interest rate sensitive names, it's not that bright right now. Let's just be honest. That it is what it is. And that's partly why Tesla is where it is. So if we get a hawkish Powell and he says what Waller says, I don't think that's going to come to a surprise, by investors in a stock like a Tesla. You're going to be like, dude, we already knew that. Like the stock's already priced for that. Are you going to discount it more? It's possible, but probably not. Now, if the economy slows, if that's the reason we get a correction, that's a bigger problem. Maybe a little bit of a slowdown in the economy could be a good thing for these interest rate sensitive names. And maybe, again, you'd see a larger correction in big tech. So it really just depends what's the reason for a correction in our markets. But let's say nothing really happens. Maybe the Fed does get a little bit more bearish. The economy just continues chugging along and we start to get some pullbacks in the markets. I think Tesla could outperform in that scenario. The markets also shrugged this off today, but it's like kind of a shot out of left field here. And coincidentally, here you have baseball as one of the trending topics here on X, but it's from JPMorgan. It's a warning for our markets. Apparently, the S&P 500 will plummet 20% and finish the year at 4,200, warns JPMorgan, which says that stocks are currently so crowded that they may crack without warning. Okay, JPMorgan tends to be very bearish. Like they've been more bearish than the average Wall Street firm for a long time, especially Marko Kolanovic and some other, well-known JPMorgan analysts. They've tended to be more on the conservative side, but A 20% pullback, just for context, I hope you guys can see this well. This yellow line would be the 20% pullback mark, 4,200 on the S&P. That would be almost at your October, November lows for 2023. I remember from the July high to the October lows, the markets corrected to the downside about 10.5%, and everyone started to freak out. You see where markets are now? Just imagine if you started to actually see a 20% correction. No, that's not going to happen unless you get no rate cuts in 2024. The optionality for a rate hike goes back on the table. That could be a huge problem. That would be like almost like a black swan event at this point. If the Fed says, this is really concerning, maybe we will need to raise rates again. We're not going to take that off the table. Yeah, 20% down from here would make a lot of sense. But unless you see a rapid deceleration in the economy is basically plummeting, or some kind of aggressive action from the Fed, 20% down from here is likely not going to happen. Or if earnings just start to miss huge, which looks unlikely because most of your earnings are coming from big tech, in which I don't think big tech's going to miss earnings that bad, even if they miss earnings. So a little bit of, I guess, if you will, bear clickbait from JPMorgan, but I am in the camp of a 5 to 10% pullback from here. Now, tomorrow's especially weird because you get major economic data, the most important data to the markets of all, just to be a matter of fact, and you hear from Powell, yet markets are not open. So I can't recall another time that this has happened, that you've got this kind of scenario set up for us. But it does put you in a very weird spot because coming over the weekend on Monday, you may see a more aggressive reaction to this data and to Powell, whatever he says, or just nothing, right? Because typically over like a weekend or a couple days, people kind of digest the news and there's less fear. Rather than, let's say, Powell was really negative tomorrow. If stocks were open, you'd probably see a panic sell-off. You're not going to get as much panic over the weekend because nobody can do anything. That's why they halt stocks for an example, because sometimes people just panic and they sell without thinking logically about the news, and that's why you'll get companies that halt their own stock, or you get a volatility halt to let things kind of chill out. And then what happens after the volatility halt? 9 times out of 10, the stock goes up. It may go down again, but typically you get a little bit of a breather there. With that said, you have trading economics estimates for core PCE month over month tomorrow coming in at 0.3%. That would be a little bit better than 0.4% that we got last month. Now, I've heard Bloomberg estimates and some other estimates are 0.4% or even as high as 0.5%. There's a lot of different estimates out there. But overall, you're still expecting a hot number tomorrow. If that comes in lower than expected, great. If it comes in higher than expected, bit of a problem. But Powell was so bullish on the last press conference that I think markets might just overlook a hotter than expected PCE report, because Powell made it clear the next stop is going to be cutting rates. If Powell throws a wrench in that coming tomorrow morning, that could be problematic. Now, Powell will be speaking at 11:30 in the morning tomorrow. If you guys want to stay up to date with what Powell is saying tomorrow, check out that link down below in the description of this video. This could be one of the more important speeches from Powell, just because, again, he will be able to correct any mistake that he made on the last press conference, right? If he didn't mean to sound so bullish, he can correct that tomorrow if he would like. Now, you're also going to get personal income month over month expected to come in at 0.4%. Honestly, as long as you're not egregiously high here, 0.4% is a very good number. That's 4.8% annualized. That is running higher than the current rate of inflation, which generally speaking, the market's like that, because if you're making more than inflation, you're probably going to be spending a little bit more. And last but not least, tomorrow we will also be getting personal spending month over month. That is expected to jump quite a bit. Last month's number was 0.2%. The estimate is 0.5% positive. A big miss there. Probably going to be seen as bad news. Again, I don't think this is a bad news is good news is bad news kind of market. Remember 2022? Most of you guys were probably invested during that time. You would get bad economic data, stocks would rip, right? Recession was like great news for stocks back in 2022. None of that made sense. And that's why 2022 is such a tricky market, because logically, you should always want the economy to do well. Inflation will run its course. You want the economy to do well. You want people to have jobs. You want companies to be able to put up earnings, right? So I don't think you're in that market anymore. So a big downward surprise in the economy, it's probably going to be seen as bad news, not good news. So be on the lookout for that. Even though you're probably not going to see that big drop off in personal spending, companies have been warning for, a slower start to 2024. McDonald's, most notably, their CFO said people are just not going to McDonald's anymore. They're eating at home more, as well as Lululemon's CFO, CEO, the whole team at Lululemon said there is a pretty dramatic slowdown in traffic going to their stores to start 2024. So different companies have had some warnings here. We'll see if that starts to get reflected in the data or not. So with all of that being said, I know that was a lot to process. And if you guys need to watch this video again, definitely go ahead and do so. And I'll keep you guys up to date here as well tomorrow, what Powell says or what the data looks like tomorrow. I'll keep you informed. We're still gonna have the normal routine as typical. Video comes out at 4, video comes out at 8 p.m. every single day. Nothing's changing tomorrow there, but it's definitely gonna be a day you want to be watching for, because to be honest, it's just a matter of time before you get a 5 to 10% correction. Just a matter of time. What causes that? Does that happen sooner rather than later? I don't know, but I think specifically Tesla stock and other interest rate sensitive names may hold up a lot better than you would think if we do go into a correction here. And I do plan to talk about this tomorrow at 8 p.m. So make sure you guys are staying tuned to the channel for that video coming out tomorrow, 8 p.m. Eastern Standard Time. I'm going to be going over my official estimate, my final estimate for Tesla's Q1 delivery numbers. But I think as long as you're above like 415,000, 420,000 or so, Tesla stock may actually go up. Okay, couple different reasons for that, but most notably, the one that I'll discuss here is the stock is already priced for that. The negativity is already priced in, and Tesla fell, including after hours, about 2.5% today. I think this was the last and final pricing in of a bad delivery number before we actually get that number. Now, if Tesla stock was up 5% today, 3% today, then you could make the argument maybe a bad number is not priced into Tesla, although Tesla has fallen a lot to start 2024. It's hard to imagine Tesla falls another 5 or 10% based on, 415,000 deliveries, 425,000 deliveries. Yeah, Wall Street's estimate, way too high. The average investor in Tesla is expecting like 420, 430, 440,000 on the higher side. So I think people are getting a little too bearish on Tesla's Q1 delivery number, and that actually could serve as an upside catalyst. Kind of the opposite of buy the rumor, sell the news. It's kind of been sell the rumor. You might see a buy the news event for Tesla, and I think that could be a really good start to this upcoming week, as long as nothing tomorrow spooks investors. And overall, let me just tell you, I think we only have a small window of time here, potentially from now until around April 17th, to get as many shares of Tesla as possible at these low prices. It is very possible, coming after this upcoming earnings, that Tesla stock does not stay at these prices for potentially years to go into the future. With the evolution of FSD, with Tesla's shift to focusing more on profitability, in my personal opinion, that's what they're going to say on this next upcoming earnings. If I am true, and I definitely could be wrong, I'm not a financial advisor, this is not financial advice. Do not buy Tesla stock because I'm buying Tesla stock or because I'm bullish on Tesla. Buy it if you want. I think most of you guys are pretty bullish on Tesla nonetheless. But yeah, really long story short, we'll talk about this more over the weekend. I think you're in for quite a large rally coming soon. Just don't hold me to that. That's my expectation. Thank you for watching. Hit the like button, subscribe to the channel, come join the trading community if you would like to. Enjoy the rest of your day, and I will see you in the next one.